Hey everyone, welcome to this week's stock and macro update. So this week there's a lot to go over once again. I'm going to start with a very brief overview of another one of our stocks, Plug Power. Then I want to get into a performance update of how our portfolio did over the past week, and then I want to get into some jobs data from last week, and then finish off with what I'm expecting and what I'm looking for in the upcoming earnings season. So this week, just to give a quick market overview, we've got inflation data, the CPI coming out for September on Thursday, and then Friday, JP Morgan reports their earnings, and it's really the official start of earnings season, which is going to dominate for the next 3 weeks or so after that. And then November 2nd is the FOMC date where the Fed is expected to raise rates another 75 basis points. So we've got a lot coming up for sure. There will be plenty to cover, no doubt about that. So just to start off with Plug Power real quick, this is one of the fastest growing companies that I have ever seen of their size. So they are a leader in the hydrogen fuel cell market. They've actually been supplying Amazon and Walmart with fuel cells for their forklifts for years now. I believe they started back in 2016 with their Amazon partnership, which is very impressive for a relatively small company to have such a big deal with a company like Amazon. Says a lot about their quality and just the overall satisfaction that Amazon has with them. They're still in that partnership. They've supplied tens of thousands of fuel cells to them at this point. And Walmart, same deal. They've been with Walmart for years now too. But revenue-wise, Plug has extremely impressive growth. So they brought in about $100 million back in 2017. Last year, that had jumped all the way to over $500 million. This year, it's expected to go almost to $900 million. So if they hit $900 million this year, that's 800% growth in just a 5-year span. So they are in the middle of a major growth phase, and it's really impressive to see. Another thing that jumps out at me financially for them, and not in as good of a way, is the fact that they're not cash flow positive. Normally, I would stay away from a company like that. Week after week, I talk about the importance of having cash flow that's able to sustain your business, so you're not reliant on debt or anything like that, or share issuance. But I think Plug Power is in kind of a unique situation. They got a little bit lucky back in 2020 and 2021, and they issued almost $5 billion worth of new stock during that time. Of course, when growth stocks were kind of going parabolic, they knew the demand was going to be there in the market. So they sold a ton of shares into the market, and they got absorbed pretty fast, and it didn't really have any immediate effect on their stock price. Of course, it's come down quite a bit along with everything else since then, but it set them up with years and years worth of cash to fund this huge growth phase that they're in. And they still have over $3.1 billion of that, so they're still set for the next couple of years at least. Whereas debt-wise, they have a little bit over $500,000 worth of debt, or $500 million worth of debt. So they've got way more cash than debt. Financially, they're very secure from everything I've seen. So even though they're not cash flow positive, still very bullish on this company. They're also the dominant player in the hydrogen field. They're also setting up the largest hydrogen fuel cell, system in the world, which is in Denmark, and that's going to power a bunch of offshore wind, which is obviously a huge thing in Europe. So they're set up in the US, they're set up in Europe, and they are just continuing to grow their sales and their business at a pretty astounding rate. So getting to the performance review. So for the past week, Monday to Monday, the Disruptors Index actually fell by 2.23%. Versus the S&P, which went up by 0.86%, NASDAQ down 0.32%, Russell 2000 up 1.66%, and ARKK, which I use as a growth proxy, down 3.79%. Top three performers in our index are MP Materials, ticker symbol MP, up 11.06%. Number two, Pinterest, ticker symbol PINS, up 5.79%, and third, Airbnb, ticker ABNB, up 5.66%. Bottom three, Tesla was the worst for the second straight week, actually, down 15.94%, DocuSign down 13.47%, and the Trade Desk TTD down 8.23%. So it was a good week for gig economy stocks and some of the commodities like MP Materials. Good to see that bounce off of 52-week lows. But Tesla, they've had a pretty sharp fall the past couple weeks. I think the stock is down 25 to 30% in that time. So I'm going to be watching carefully for what they report in their earnings statement, which comes out just a week from today. Let's get into the jobs data. So there was a lot last week. I want to focus on two main things, though. I want to focus on the JOLTS report, which is job openings, and that was released last Tuesday. And I want to focus on the unemployment report that was released last Friday. So for JOLTS, it was reported that the total number of job openings actually fell by 1.1 million jobs in the month of August. So this is a little bit of a lagging data piece, but it's still, pretty useful to see which sectors of the economy are pulling off their job listings or adding more job listings, because it shows you what's in demand overall in the economy. The one area that I'm watching the closest is leisure and hospitality. So that is the most cyclical sector in the economy, because when things are good, when people are spending money, leisure and hospitality benefits. That's things like restaurants, hotels, cruise ships, all kinds of things like that, just for travel and things like that. And this is still one of the strongest areas in the job openings market and in the jobs market in general, which shows me that the Fed isn't too worried yet, because the part of the economy that is highly cyclical still looks strong, at least on paper. And although the amount of job openings fell and have fallen in leisure and hospitality by about 30% since March, they're still way higher than they were pre-COVID. So there's still tons of jobs out there. Companies are still looking to hire because they see strength, at least in the short term, for their businesses. And it's still actually the leisure and hospitality sector still makes up about 14% of the total job openings on the market right now. So it's still a big chunk of the current job openings. It's the second biggest sector in the jobs market as well. And I think we're going to need to see months of destruction in this sector from a job perspective before the Fed sees, that things are not looking good in the jobs market. And I'm not saying that the jobs market is the strongest indicator of the economy. Obviously, it's a lagging indicator, but this is what the Fed looks at. And if we want to be able to understand what the Fed's going to do with their interest rate policy, we have to be able to think like them too. So I think we're going to need to see months of something like this, where we see job openings come down by millions by the month, in order to see the Fed maybe start to understand that things in the economy are not exactly great. Unemployment, so that is back down to 3.5. This is the Friday report. So all of those people that poured into the jobs market in August had no issue at all finding jobs. Because if you remember, I talked about I believe it was like 700,000 people that re-entered the job market, which there are still a few million left out there that could over the next year or so, 6 to 12 months. And so all of those people that made the unemployment rate tick up last month, even though there were net jobs created, those people had no issue, again, finding jobs at all, suggesting that the jobs market is still very strong, that anybody really who's looking for a job will not have trouble getting one. The thing that was really not good, and in this kind of scenario, you kind of want to see things that are not good to suggest to the Fed that maybe things aren't great. It was the hourly wages and just wages in general. So over the past year, hourly wages went up 5%, and weekly wages only went up 4%. And that's on a nominal basis, so that does not account for inflation. So really, that means that people are not making as much as they were a year ago when you factor in inflation, which is bad, again, for the consumer, which is bad for personal savings, consumer spending. But as I've said before, I don't think we're going to see too much pain in the overall consumer economy until people start to lose their jobs. And I know it's, I'm not saying that I'm hoping for people to get fired, but from a macro perspective, I don't think that we're going to see people start to save their money more unless some layoffs happen, or we see increases in energy prices again. That's what did it earlier this year. And then when oil went down, when gasoline went down, heating oil, natural gas, when those prices went down, people all of a sudden started spending on discretionary stuff again, which is what we don't want, because that's what the Fed can really hammer down with these interest rate hikes. They can cause a lot of demand destruction with that. So if energy prices come up, that's going to create demand destruction on its own. But other than that, again, people are still spending money. And the things they're spending money on, a lot of that is in retail, leisure, and hospitality. Those are the two big cyclical sectors of the market. Retail, the jobs market is pretty bad. That's back way below where it was pre-COVID, whereas leisure and hospitality, again, is higher than it was before all that. So I think that overall, we're still, just got to play it day by day with data that comes out. The jobs market's still clearly pretty strong, even though people aren't making as much. And it'll be interesting to see at what point people really stop spending money, because, again, the discretionary spending, I think, picked up a ton with all the stimulus checks and things like that, and higher benefits for unemployment. And people just had more money sitting around. Plus, the stock market was going up, which usually creates a wealth effect where people are okay with spending more money, even if it's on credit cards or things like that. So people got used to that lifestyle for like a year, and I think it's still sticking with people, and they can't break themselves from it. So we're seeing credit card debt go up. We're seeing personal savings the lowest since 2010. And yeah, credit card debt's at all-time highs. So very interesting dynamic here between the jobs market and just overall consumer spending. And I don't think we're going to see a decrease in consumer spending, or at least a noticeable one, until we see pain in the jobs market. And I think with just the last thought to wrap this up, with consumer spending, I think we're going to need to see months of serious decline in that area for the Fed to really even notice that and say maybe we should stop raising interest rates, do a triple rate hike every single meeting. So that's what I'm seeing right now in the jobs market. I want to get into earnings season next. So AMD came out with a surprise last Thursday, and they said that their sales for Q3 is actually going to be way, way lower than expected, 16% below what Wall Street was expecting for Q3. That's their sales, not their profits. So their profits are probably going to be even worse, just because margins have been hit so hard, especially in cyclical sectors like semiconductors. But this tells me, it actually reminds me of Micron, what they reported back in, I believe it was June. They came out with preliminary earnings, which basically means they gave their earnings information a little bit early, and they did the same thing. It was way worse than expected, and it kind of caught the market off guard. So this is the second time we've seen that in about 4 months. And I think this might be the quarter that we finally start to see sales take a hit. But I'm not 100% on that because, again, consumer spending started to tick up again towards the end of Q3 because energy prices were so low. So we might not see that. We might see, further declines in earnings per share, which is profits, but maybe not sales. And there's 3 areas that I'm going to be watching closely during earnings season, and those are chips, retail, and housing. So went over AMD, but some other big ones, like NVIDIA, ST Microelectronics, Texas Instruments. These companies are in different areas of the semiconductor market, and until now we've seen some strength still in industrial and automotive semiconductors. So it'll be interesting to see if the demand for those are coming down as well, because demand for computing things like GPUs and CPUs and memory the demand for those is extremely low. So those kind of companies, AMD, Micron, NVIDIA, are probably still going to get hit pretty hard. But the rest of the semiconductor market, it'll be interesting to see their position right now too. As for retail, two main questions I'm going to be looking for answers to are: will retail companies be able to afford to keep paying dividends and share buybacks? And also, how are they managing their inventory? Because over the past 2 quarters now, we've seen, actually really over the past year, we've seen inventory build up like big time for companies like Amazon, Walmart, Target, Home Depot, the biggest retailers on the planet. And if they can't sell their products, they're going to have to put them on huge sales, which means overall, on a per item basis, their sales are going to be lower, and that means they bring in less cash per sale. And I want to know if the cash that they're bringing in is going to be enough to sustain any kind of buyback or any kind of dividend. We might see some pretty serious dividend cuts here, which would be very bad for the stock price, because the reason people buy these companies at this point is because they create scarcity in their stock by buying shares back, and they also pay out a yield with dividends, so there's an income aspect to it too. I don't think that people are willing to hold on through things like dividend cuts, especially on companies that are supposed to be among the safest in the market. So that'll be interesting to watch too. So housing, want to finish off with that. So really there's been a huge deterioration in the housing market, as I'm sure a lot of you have seen. The mortgage application index actually fell by 12.6% last week, which is the fourth worst weekly drop in the past 13 years. So demand for new housing is destroyed. There's hardly anyone going out there who wants to buy a home when prices are still relatively high. They're still way higher than they were pre-COVID. And on top of that, the mortgage interest at this point is like 7% for a 30-year mortgage. So those are both horrible things that nobody wants to really deal with at this point. So we haven't seen this pain unfold in housing earnings yet, in at least housing stock earnings. So Lennar reported a few weeks ago at the end of September, and they reported 29% sales growth and 58% earnings per share growth. So clearly they're still doing all right. So the whole thing with the lack of new home buyers has not hit them yet. They're one of the stronger companies, but still, I was very impressed to see that they're still seeing that kind of growth. So my question for housing is, are we going to see that kind of growth in the housing sector overall? And, at some point, we are going to see this pain in the mortgage market unfold in the housing stocks. But, this might not be the quarter yet. It might be Q4. Even though in Q3, mortgages were way down, or the mortgage applications were way down. Rates are higher. Not as many people are as incentivized to move. The one thing in Lennar's earnings actually that stood out to me that is not good is the fact that they had a 21% cancellation rate, definitely above average. So a lot of people are canceling their purchases. So, they're still relying on higher house prices to sustain their business, but I don't think that's going to be the case much longer, especially as people want to sell their homes and, aren't going to get any buyers at, 7% mortgage rates at, 50% higher than just a few years ago in the home value itself. So it'll be interesting to see how fast the earnings drops off a cliff for housing stocks. And again, it's probably not going to be this quarter. It might be for some of the weaker stocks, but those could be a leading indicator for Q4 of this year, and Q1 next year is really when I think things are going to get bad for those. So what does this all mean for the stocks in the Disruptors Index? So I want to mention three things. Things to avoid when you're looking for companies. Number one, avoid companies in the late stages of their business cycle. So this would apply to housing stocks, chip stocks, retail, things like that. And I know that leisure and hospitality can apply to gig economy stocks like Pinterest, Uber, Airbnb. But the difference in these companies is the gig economy is kind of works both ends, because yes, it is kind of a discretionary good, but for example, with Uber, you can also make a side income doing that, just driving people around. And a lot of people are definitely going to be looking for side income, especially if there's a bunch of layoffs. Same deal with Airbnb, and same deal with Pinterest. You're selling a service that you are creating yourself, and you don't have like a company over top of you telling you what you can and can't do, and that has to go through like a formal hiring process and things like that. You're on your own, which an increasing amount of people actually, I think, actually want to do. So avoid companies in the late stage of their business cycle. Number 2, avoid companies that are highly exposed to foreign currencies. So this isn't something I talked about a lot in this video, but I go into it in a little bit more detail in the Substack. The dollar right now, I'm sure a lot of you have seen, is extremely strong. The euro is less than $1 for the first time in, I believe, over 20 years. The pound almost went down to $1. That's still hovering around $1.10, I think. The yen has fallen off a cliff, and most of the major currencies on the planet are crashing against the dollar. So a lot of companies, especially the bigger ones that I don't really focus on anyway, like Apple, Microsoft, Google, these bring in a ton of money from overseas where it actually hurts their earnings. And just to throw out a stat, I believe it's 40% of the total revenue of S&P 500 companies comes from outside the U.S. So with the 21 Disruptors Index, a lot of the revenue comes from in the U.S. These are companies that are that either produce or sell or both a lot of their products within the United States. So it's all in the dollar, which at this point is a very good thing to have. Number 3, avoid companies that are reliant on debt to fund their operations. This is something I've been harping on week after week, so I won't go too much into it because you've heard it all before. But companies that are relying on debt are going to be in for a very, very rude awakening over the next year or so, when they need money either for their operations or for less important things like dividends and share buybacks that they've wasted so much money on over the years. And they're not going to be able to get it because banks are tightening their standards rapidly, and yeah, they're going to be in serious trouble. So, some themes for the Disruptors Index. Actually, one of the main themes is just to buy cash-heavy, debt-light stocks, and I think that's going to be that's still in the very, very early stages of being a narrative in the market. But I think that you're going to see more and more people talking about that over the next 6 months or so. So those are 3 things that I just want to remind everybody of when you're looking for companies, and these are definitely rules that I stick by with the 21 Disruptors Index. So hopefully everybody got something good out of this video. If you have any questions, feel free to leave them below. And other than that, I will see you Friday for the crypto update, and thank you very much for watching.